to Amy to keep this thing going as lively as it is for all that time. Let me say we are dealing with events, I think, without precedent. We had a big problem in the late 1920s and early 1930s. I ran across a letter that my then 35-year-old mother wrote to her mother, who had apparently written to her expressing concern about the stock market crash in October. This letter was written on November 15th. And my mother wrote to her that these markets are volatile, they go up and down. I wouldn't worry about it too much. Those people who, bought on margin, they're gamblers. They deserve to lose. Easy come, easy go. So long as they continue to pay dividends, you'll be all right. It's only paper anyway. Well, she was half right. It was volatile, all right. It got a little worse than she was anticipating. But I thought that kind of calming letter probably fits today's circumstances. We do have an extremely complicated picture in financial markets, and let me confine, at least at this stage, my comments to that. I've been a little suspicious of these markets over time and the proliferation of derivatives and complications and CDOs and CMOs and SIVs and CDO squared and so forth. I didn't realize that it would create quite the problems we've seen. Instead of spreading the risk and creating transparency, I think we've ended up obviously with some pretty concentrated risks and opaqueness instead of transparency with all the complications. I wasn't intending to tell this story with distinguished academics next to me, but it strikes me as appropriate. I was at a meeting the other day with people worried about infrastructure, which is a common worry. And I share that worry that our infrastructure needs repair in this country and hadn't had sufficient attention. And after all the moaning at the meeting, there were no great answers, but a rather elderly participant, probably not as old as I am, announced himself as a professor of civil engineering at a prestigious university. And he said, I've just been up there at Yale and they've abandoned teaching civil engineering. I was up at Harvard and they haven't got much of a department. What he was implicitly saying, but he didn't say, when I retire, my university won't have much of a department. And he said, what's the result? It costs twice as much to build a bridge in the United States as it does in Europe. Our bridges tend to fall down, theirs don't. And besides, ours are ugly. And any of you who have been to Europe or Asia have seen some of the really very beautiful civil engineering works. Well, that made me think that the trouble with American education in recent decades has been we produce very few civil engineers. We produce a plethora of financial engineers. And what's the result? Lousy infrastructure and a lousy financial market. Having finished with that, maybe unimaginative comment. We have a crisis in its complexity, I think, without any precedent that I know of. We had a very bad problem in the 30s, obviously, but it wasn't as complex. This one is so difficult to deal with because of its complexity, but there's been no loss of effort in trying, as you know, where we go along almost month by month, week by week, almost day by day, with unprecedented measures by either the Federal Reserve or the Treasury of others that would have seemed, still seem to me unimaginable. I don't say unwarranted, but if you'd asked me of a central bank taking the kind of measures that the American Central Bank has taken in the past year, I would have said not possible. If I would have thought that there would be the degree of intervention that there would be by the Treasury, I would have said not possible. If you asked me whether it was worldwide, I would say, at least among developed countries, I would have said not possible. But somehow it's all happened. Can you imagine a partially, I say the word partially kindly, nationalized banking system, at least for the major banks in the United States, and a more fully nationalized banking system in most of Europe, with you know, hundreds of billions of dollars being paid to support the central financial institutions after some of the presumably subsidiary financial institutions, like the world's leading investment banks, have been swept off the stage in one great puff and puff. Now, I'm not going to attempt to answer these questions, but let me raise a question, not answer the questions of what we do just now, but where is all this going? A friend of mine sent me a unexplained two-line haiku, you know, the Japanese little aphorisms, always in two lines. Says, the barn's burning, now we can see the moon. So I want to talk a little bit about the moon. I think we really are going to have to rebuild this system pretty much from the ground up. The system is clearly rebuilding itself. We have a disappearance of at least freestanding large investment banks. We still have obviously a lot of small ones around the world. We have a centralization, maybe it's been going on anyway, but a further rapid centralization of banking, so you have some really huge institutions getting bigger. We have never had this kind of concentration of commercial banking in the United States. It is more typical of Europe, and even Europe is getting more concentration. And this raises, I think, a number of issues. It raises a very simple issue, just looking backwards a bit. Are institutions of that size and complexity really manageable, given the complications of modern finance? And maybe an open question, but I think it's a real question. Secondly, it's not new, but it's getting worse. These institutions, by their nature, imply tremendous amounts of conflict of interest. You cannot have an institution that takes deposits, does underwriting, invests in companies, does M&A, does investment management, and is a major trading institution without running into conflicts of interest. And does that stand? Do we do something about it? Easier to ask the question than to say what to do about it. And then finally, with this clear protection of the major financial institutions in the United States and in every other country, an admission, a full admission that they get in trouble, they're going to be protected. And I'm not again, I think they faced a situation where that was necessary, and I have written that it was necessary, and it should be done on an international scale. So I'm not criticizing it, but what are the implications of that over time? Bob spoke about the lessons of the past and the worry that if monetary policy is relied upon too much and you give everybody the assurance that monetary policy is going to take care of every problem by a flooding of liquidity, with the consequence you may have a future inflation and future bubbles, and it may get progressively worse, and by some interpretations that's what's happened in the past. Doesn't seem very satisfactory. And I don't think we can avoid this moral hazard question that has bothered economists and others from time immemorial, I guess, and wanted to limit official bailouts, to use that word, precisely for the reason that people will come to expect it, and if they come to expect it, they will take undue risk. Now, there hasn't been much bailout of equity holders in many of these institutions this time, but clearly creditors have been protected, and I think it's a fair presumption that people will assume that they will be protected in the future for these large institutions. And if that is true, how does that affect behavior patterns, and what does it imply, both the conflict of interest question, the size question, and this question imply for regulation? I don't think regulation is the answer to all problems. That's been demonstrated in the past. We've had lots of regulators. Maybe we can do a better job. I think we can do a better job. And it will have to be more